Hey y'all, welcome back to the channel. So I've been getting a lot of questions lately about alternatives to home equity loans, and it's something I've been digging into myself. Like most folks, the idea of taking on another monthly payment makes me wince just a little bit. I was looking at some home improvements I wanted to tackle, but every time I start researching home equity loans, I get to that monthly payment part and just no. That's when I started hearing about point home equity. Instead of monthly payments, they basically buy a piece of your home's future value. I spent some serious time digging into how that possibly works, and I think I've got enough experience at this point to tell you whether it's worth considering or just stick with what you know. All right, so Point Home Equity is this California-based fintech company. It's been around since 2015. Instead of giving you a loan that you pay back monthly, they give you cash right now, anywhere from $30,000 to $500,000. And in return, they get a share of whatever your home's worth when you eventually sell it or pay them back. Now, here's the wild thing that hooked me. There are no monthly payments at all. You don't even have to prove your income or have perfect credit. They'll work with credit scores as low as 500 for someone who's been through the whole loan approval process before. That one's pretty refreshing. They call it an HEI, home equity investment, and it works in 27 states right now. You need at least 30% equity in your home, but, and here's something cool, they'll work with both your primary and investment properties. Most lenders get a little picky about that kind of stuff. The catch, well, when you do sell your house or refinance down the road, you owe them back whatever the original amount was, plus a chunk of whatever your home has gained in value, usually somewhere between 25 to 40% of the appreciation. So if your house goes up a lot in value, they're going to get a pretty nice payday too. The application process is pretty smooth. You can check if you qualify in like a minute with just a soft credit pull. It won't ding your credit score or anything. I checked it out myself just to see what they'd offer. The whole thing, totally straightforward. Once you decide to move forward, everything is done online. They'll order an independent appraisal to figure out exactly what your home's worth. Then they'll give you a final offer. The whole thing can close in like 3 weeks. Now, here's where it gets fun. You don't pay anything back until one of three things happens. You sell your house, you refinance, or you just decide to buy back their share within 30 years. That is a lot of flexibility right there. And if your home actually goes down in value, Point shares that loss with you. So you might end up paying back less than what you originally got. Now that is something you do not get with a regular loan. Let's talk about what this actually costs, because this is where things can get a little complicated. Point charges a 3.9% processing fee with a minimum of $2,000, plus appraisal fees up to $1,000, and some reconveyance fees between $40 and $70. But here's the big thing. They do what they call a 27% risk adjustment. Basically, they knock 27% off your home's appraised value when they're figuring out how much cash to give you. So if your house appraises for $500,000, they're going to base their offer on $365,000 instead. So let's do a real-world example here of how that repayment system works. Say you get $50,000 from Point, and over the years, your home goes from $500,000 to $600,000. You'd owe back that original $50,000 plus their share of the $100,000 appreciation. If their share is about 40%, that's $40,000. So you'd repay about $90,000 total. Now that might sound like a lot, but when you break it down over 10 years with no monthly payments, it's actually very competitive compared to what you pay in interest on a regular loan. By the way, if you're interested in giving Point a try, check out the link in the description. For most products we talk about, we have special deals that you wouldn't be able to get if you went straight to their website. The main competitor everyone talks about is HomeTap, and there are some pretty big differences. Both companies do the whole no monthly payments thing, but Point gives you 30 years to pay back versus HomeTap's 10. That extra time makes a huge difference if you're not planning to sell anytime soon. HomeTap may offer a wider range, $15,000 to $600,000, compared to Point's $30,000 to $500,000. But Point has got way more flexible qualification requirements. HomeTap wants a 600 plus credit score and only works with primary residences. Point will work with as low as 500, and they'll do investment properties as well. But the transparency thing is where Point really wins. Look, that 27% risk adjustment, it sounds scary at first, but at least they're upfront about it. HomeTap manages risk too, but they're not as clear about exactly how they do it. Okay, let's be real. What works and what doesn't? The big point, obviously, no monthly payments. If you're already stretched thin or you're retired and living on a fixed income, that's huge. The flexible qualification requirements are legit too, like no income verification, low credit score requirements, and they'll work with investment properties. You also keep full ownership of your home. Some people naturally worry about giving up control, but that's not what's happening here. You can still renovate, refinance if you want, or sell whenever you choose. But, reality check, you are giving up a chunk of your home's future value. If your area sees crazy appreciation over the next few years, Point is going to get a nice piece of that action. And that 27% risk adjustment means you're getting less cash up front than your home's actual appraised value. And here's something that kind of caught me a little off guard. If you do renovations or improvements, those don't reduce what you owe Point. So let's say you put $50,000 into a kitchen remodel that adds $75,000 to your home's value. Point still gets that share of the $75,000, even if you paid for the improvement. And obviously, they're only in 27 states right now, so depending on where you live, this might not even be an option. Look, Point Home Equity isn't going to be the right choice for everyone. But for certain situations, makes a lot of sense. If you need cash now, but monthly payments would stress your budget, or if you've got less than perfect credit, or you're planning to stay in your home for a long time anyway, Point can be worth serious consideration. The 30-year term gives you way more flexibility than most alternatives, and the fact that they share in the losses if your home value drops is actually pretty fair. Just make sure you understand that risk adjustment thing and factor it into your decision. Go with Point if you want to avoid monthly payments, you've got decent equity but maybe not perfect credit, or you're not planning to sell anytime soon. Skip if you're in a hot real estate market where you expect massive appreciation, or you're just already planning to sell within a few years. And just a quick reminder, if you're thinking about trying Point, don't forget to check out the link in the description. Like I said, for most products we talk about, we have special deals that you wouldn't be able to get if you went straight to their website. And that is a wrap on this one. If you're dealing with home equity decisions yourself, I would love to hear how you're thinking about it. Drop a comment below and let me know what's driving your decision. Are monthly payments the deal breaker for you, or is it something else entirely? Thanks for watching, and I'll see y'all in the next one.